Most financial decisions don't feel important when you make them, but they quietly decide your future. You don't feel it in the moment. You feel it years later. A loan here, a commitment there, a few fixed expenses that seem reasonable. Individually, they feel small. Collectively, they shape direction. This is how financial pressure actually builds. Not suddenly, but gradually, and often without being noticed. Most people don't wake up one day and decide to limit their financial future. It happens through normal decisions. A car upgrade, a slightly higher rent, a subscription that becomes permanent. Nothing extreme, nothing reckless, just consistent. And consistency is what makes it powerful. Because every commitment you take on does one thing. It reduces future flexibility. That's the part most people don't see. They see the cost, but they don't see the structure. They see the monthly repayment, but not the long-term effect. This is where expenses, debt, and commitments start to behave differently. They stop being transactions, and they start becoming constraints. A constraint is not just a cost. It is a limit on future options. And once enough constraints exist, choice starts to narrow. This is why two people with similar incomes can end up in completely different financial positions. Not because one earns more, but because one has more flexibility, and the other has more commitments already locked in. Debt plays a major role here, but not in the way most people think. Debt is not just money that needs to be repaid. It is future income that is already assigned. Before it even arrives, that changes the nature of income completely. Because income is no longer fully available, part of it is already spoken for. And that reduces control. This is why people can earn well and still feel restricted. Not because they are doing something wrong, but because a portion of their future has already been decided. And that decision was made earlier, often in small steps. This is one of the most important shifts to understand. Financial pressure is not only about how much you spend, it is about how much is already committed. There is a difference. Spending is flexible, commitments are not. A one-off expense can be adjusted. A long-term obligation cannot. This is why fixed expenses matter more than variable ones. Because fixed expenses continue, every month, every cycle, whether conditions change or not. This is where many people feel stuck. Not because they cannot earn more, but because increasing income does not remove commitments. It just supports them. This creates a situation where effort increases, but flexibility does not, and over time, that gap becomes noticeable. A simple example makes this clear. Imagine two individuals earning similar salaries. One keeps their fixed commitments relatively low, the other gradually increases them over time. A larger home, a financed car, ongoing lifestyle costs. Nothing unreasonable, just more locked in. At first, both feel similar, but over time, the difference appears. One has room to move, the other does not. One can absorb changes, the other feels every shift. This is not about discipline, it is about structure. Because structure determines how income behaves, not just how it is spent. Another layer to this is how commitments are perceived. They often feel invisible once they become normal. A mortgage payment stops feeling like a decision. It feels like a given. A subscription stops feeling optional. It feels standard. And once something feels standard, it is no longer questioned. This is how systems quietly stabilize. And once stabilized, they are difficult to change. This is why financial direction often feels fixed. Not because it is impossible, but because structure resists change. There is also a timing effect. Decisions made today extend into the future. A 5-year loan, a 30-year mortgage. These are not short-term events. They are long-term paths. And once entered, they shape what comes next. This is why financial direction is rarely sudden. It is built slowly. Through layers of commitments, each one adding a little more weight, until flexibility becomes limited. This leads to a common experience. People feel like they need to keep earning, not to grow, but to maintain. Income is no longer about building options. It becomes about sustaining obligations. And that feels very different. This is where the feeling of being stuck comes from. Not lack of opportunity, but lack of space. Space to change direction, space to adjust, space to make different decisions. Without that space, even good income can feel tight. Stable, but constrained. Everything works, but nothing can move. This is not a budgeting issue. It is a system outcome. And once you see it that way, it becomes clearer. Most people do not run out of money. They run out of flexibility. If this helped you see things differently, subscribe to Finance Systems Explained Australia. In the next video, we will look at how assets are actually built over time.